What's going to happen to UK house prices? The truth is, I don't know. I'm going to run through the possible scenarios and I'll try and give you the best and worst case forecasts. Let's look at the most recent developments. This chart shows the monthly change in UK house prices in percentage terms. Prices have definitely taken a downward turn in 2023. We can see that in most months it's fallen. This can be compared to the financial crisis in 2008, and it can be seen that falls this year don't seem to be as bad as 2008, at least so far. This data is from nationwide and it actually shows prices staying flat in September 2023 compared with a 0.8% fall in August. Halifax data is a little bit more negative, showing a 0.4% fall in September and a 1.8% fall in August. In total, the annual fall in the year to September 2023 is a little bit more than 5%. Now, how does this actually translate into the price of a house? The 5% fall has meant that the average price of a house in the UK has fallen from a peak of 273,000 to 257,000. We can compare this with the last big fall in prices in 2008, where prices fell from 186,000 to 147,000, a 20% fall. So the fall is fairly moderate so far, particularly taking into account the big increases in house prices that have occurred since 2020. We can put this into a broader context by looking back to 1952. Incidentally, the price of a house in 1952 was £1,891. There's been two market crashes during this period, one in 1989 and the other with the financial crisis of 2008. In 1989, there was a 19% fall. So I do think that in 2023, where we are hanging over a cliff edge, and the big question is what will happen to prices going forward? We can see that the fall this year is only the third time that there's been this type of disruption to house prices since the 1950s. We definitely wouldn't call it a crash yet, but it could well turn into one. It's very easy to make predictions, but who knows if they'll be accurate. What we can do is look at the facts that can guide us. First, let's look at what's happened to interest rates. This chart shows the official Bank of England rate, which is the basis on which mortgage rates are calculated. Mortgage rates are typically 1 to 2% higher than this. This is definitely going to stay high for at least 2 years. We can see here that the Bank of England forecast is that it'll still be 5% in 2025. Mortgage payments are becoming unaffordable for many people, and this is only going to get worse with these high interest rates. The worst of the cost of living crisis is still to come. I think we've probably only scratched the surface in terms of the increased mortgage costs that many people are going to face. What happens in a market when the product is unaffordable, of course, is that the price falls. So this is the first factor suggesting prices will fall. The second issue, and it's kind of related to the first, is that there has been an increase in mortgage arrears. The FT ran this story saying that mortgage arrears are at a 7-year high, and this is the graph shown by the FT showing a massive increase in 2023. Unusually for the FT, they exaggerated the current situation in the way they presented the data. It's not yet quite as bad as the FT reported. Looking back to 2007, we can see that mortgage arrears have had a long period of falling very significantly. The increase shown by the FT only comes comparing with 2016. It makes the 2023 increase seem much bigger than it is. That's not to say that it's not significant. It is a clear turn in the trend. It's very worrying because many people are still on fixed low rate mortgages, and these mortgage payments are going to increase dramatically over the next 12 to 18 months. Again, this issue feels like we're hanging over a cliff edge in terms of mortgage arrears. The third issue is something new. There's a difference between the previous price crashes and today, in that today we have a much bigger gap between house prices and earnings. In fact, it's significantly higher than it's ever been. If we look at the trend from 1997 in index form, where 1997 is 100, we can see that house prices have increased much quicker than earnings have. So in 1997, house prices were 3.5 times earnings. And in 2023, they're 8.3 times earnings, a massive and unprecedented increase. Schroders produced a little bit of research showing that the last time it was this high was actually in 1876. And it's not really comparable because the rate was higher then because there were less houses, they were bigger and more expensive houses, and incomes were lower. The market has dramatically changed since then. But despite that, the house price to earnings ratio is disproportionately high in 2023. This really is a unique situation that the market has never experienced before. One thing we can note is that the affordability problem is much worse in the south than in the north. This chart shows that back in the 1980s, the ratios differed but were relatively close to each other. Over the past 10 to 15 years, there's been a dramatic widening of the gap. London and the southeast is particularly high in terms of this price to earnings ratio. So that means that the risk of a house price crash is much higher in the south of England than it is in the rest of the UK. It really seems to me as if house prices at 8 times earnings is just unsustainable. Economically, I'm not sure how long this continue. Many people are excluded from the market, and it really feels like the market will have to adjust to bring those people back in. There's also a political point here, I think. From an equality perspective, we're going towards a place where only the rich can afford to buy houses. And as this problem gets worse, the profile of this as a political issue could well increase. So to summarise, prices are falling, but only by 5% so far. The previous crashes have seen falls up to 20%, so we're nowhere near a crash just yet. There are a number of very significant risk factors. Firstly, interest rates will remain high, which means that the cost of living crisis will continue. Secondly, there's been an increase in arrears, and this could get a lot worse. And thirdly, the fundamentals of the market are completely out of line in terms of affordability. It seems to me like a market adjustment will be absolutely required to correct this. In terms of a house price forecast, it really could go any way. It's very likely that prices will fall 10 to 20%, and I would say this is the best case scenario. It could be more. There is a further risk factor here that if we were to have another pandemic, another climate crisis incident, or another war, any of these could throw the global economy into more crisis. And these type of crises affect the supply of goods, which would be inflationary. Interest rates will perhaps have to go even higher, making the cost of living crisis worse. And I think that this would negatively affect house prices, particularly by making the arrears problem even worse. So what would the worst case be? Some have forecasted 30% falls in house prices or even higher. One simple way of looking at it is to ask, what is a sustainable house price to earnings ratio? If it's 6%, house prices would have to fall by 25%. If it's 4%, house prices would have to fall by 50%. In itself, 4% seems like a reasonable house price to earnings ratio. It's hard to imagine that house prices could fall 50%, so it's unlikely. But you know what? It's not absolutely impossible. We live in such uncertain times. What will happen to UK house prices? Nobody knows. But the risk of a further price crash is high. I hope you found this information useful. If you did, please consider liking and subscribing. Thanks for watching. See you next time.